Most people sign a 30-year contract without really knowing what they agreed to. And that contract is their mortgage. Now, in this video, I'm breaking down exactly what a mortgage is in plain English so you don't get played by the bank and you actually understand what you're signing. What's going on? It's your favorite businessman, CEO Rico. On this channel, we talk about money, business, and how to make smarter moves with your finances. Today, we're talking about mortgages, what they are, how they work, and what you need to know before you actually jump into one. Let's get into it. So let's start simple, right? A mortgage is just a loan used to buy or refinance a house or a property. You don't usually walk in with $300,000-$400,000 cash. So you go to a lender, could be a bank, could be a credit union or a mortgage company, and they front you the money to buy the house. In exchange, you agree to pay that money back plus interest over time, right? Now, here's the key part to the whole thing, right? The house itself is the collateral, right? Now, what does that mean? That means if you don't pay, the lender has the right to take the house back through something called foreclosure. Now, a mortgage is not just I bought a house. It's more like I agreed to a long-term loan and the house is on the line, right? So moving forward, now let's break down the basic pieces of a mortgage. So when someone starts talking, you understand the language that they're talking. So first, you got the principal, right? As you can see, it's a huge part right here, basically. Now, that's just the amount of money that you actually borrowed. If the house is, let's say, $300,000 and you put down $30,000, right? Your principal is about $270,000. So basically you got 30 grand in the game. It's called skin in the game. Now, next you got the interest. Now, that's the price you pay to the bank for using their money, right? So that's how they get paid. And that's the mutual exchange. They give you the money for the house. In return, you're going to pay them over time for them letting you borrow the money. They're in the long game, right? So then you have the loan terms. That's how long you have to pay it back. Most people hear about 15-year mortgages or 30-year mortgages. Shorter term usually means higher monthly payment, but less interest over time. That's the difference. That's the trade-off. If you're going to pay it off in less time, you're going to pay less interest, but you're going to pay more money. Now, if you go for a longer duration of time, you're going to pay more interest, but you have a less monthly payment. So you got to decipher which one is more beneficial for you. So your monthly payment usually includes what? Your principal, your interest, and in a lot of cases, taxes and homeowners insurance as well. Now, that part is handled through something called an escrow account. That just means that the lender is holding money aside from your payment to pay your taxes and insurance for when they are due. This is something you can pay on your own if whatever program allows for you to do it, depending on what your circumstances is, finances, stuff like that. But in some cases, you won't have that option depending on the lender that you're dealing with. Now, let's actually discuss how a mortgage works month to month. So how does it actually work, right? So every month you make a payment. In the beginning of the loan, most of the payment is going towards your interest. As you can see in this little chart right here, 30-year, the red is the interest, the black is the principal. So as you can see, it starts off very low for the actual principal paid because mortgages or just loans in general, they are front loaded, which means the institutions, the banks, whatever, they want to make their money up front. Reason being, typically the industry average is people typically tend to refinance anywhere between 5 to 7 years on average. So the banks, they want their money up front. So if you constantly refinance properties, you're going to pay more long term, right? So in the beginning, like I said before, most of the loan is going strictly towards interest. Now, not the principal, right? So that's why it feels like the balance barely moves at first. So if you actually know anyone or seen anyone, they go into make payments on a loan and they will complain. Let's say their monthly payment is $2,000. But when they actually look at the breakdown, they'll see maybe only $200-$300 is actually going to the principal and the rest is going towards the interest. That's what I mean by front loaded. And also, guys, let's not forget, these loans are amortized. I'll break that down in another video. So with majority of it going towards the interest and less going towards the principal, as time goes on, the balance slowly drops. And the more of your payments start actually going towards the principal. So this is where you actually start to build the equity in the property, right? That's the part of the home that you truly own, right? The equity. Now, if you stop making payments, the lender can move to foreclosure. Basically, they take the home back and they sell it to get their money. Now, here's a big thing. Banks don't like to do this because they're not in the real estate industry. They're not in the home property game. They're in the money game. So they don't want to take your home. They want you to pay for your own home. Now, if you pay extra towards the principal whenever you can, even if a little bit, that can actually help you pay out the loan faster and save a lot of money and interest over the years. Just keep something like that in mind. We'll talk about velocity banking in another video because this is something that is truly beneficial. Now, let's actually hop into the common types of mortgages. Now, what you will see and what you will hear, so you're not confused at the bank, right? So let's talk about the fixed rate mortgage. All right. Now, with the fixed rate mortgage, it's simple, right? It's a simple one. Interest rate stays the same for the entirety of the loan. That means your principal and interest payment is predictable. A lot of people like this because it's stable, right? Now, let's talk about the second one. This is the adjustable rate mortgage, which typically they refer to it as a ARM. Now, with the ARM, the rate is usually fixed for a certain number of years at the beginning, and then it can adjust up or down based on the market. Your payment can change, and that's where people sometimes get surprised, right? Typically, you want to have a conversation with either the bank or your mortgage broker or whoever and just get the terms and what's going on, because you can get really fancy when it comes to the adjustable ARMs. You just got to be smart and strategic on how you want to approach it. So then you got the actual conventional loans. So these are not backed by the government. They usually want a decent credit and a solid down payment. Now, here is how can I say it? A myth out there that we're going to break. Typically, people think that you have to put 20% down in order to get into a conventional product. That is false. Typically, you only need 3%. And in some cases, depending on the market and the programs, things like that, they have programs where you can actually put 1% down for a particular program. So just keep that one in mind, right? Now, then we have the government-backed loans. That's more of your FHA, VA, USDA. These can be helpful if your credit isn't perfect, because as you guys have already seen, Fannie Mae remove their minimum credit score requirements, which we can talk about that later on, but that's not like, oh my God, that's a great thing. So you don't have to have a huge down payment, or you qualify through military service or certain areas. The main thing I want you to hear is that not all mortgages are the same, and the type you choose affects your payment, your risk, and how much you pay long term. Keep that in mind. So let's actually dive into what the lenders actually even look at. So when you actually apply, they're not just handing everyone a check, right? So while yes, the lenders are in the business of giving out money, that doesn't mean that they just want to give it to anybody. Think of it from the standpoint of you as an individual, you are lending money to people. Do you want to lend money to people who have a checkered past as far as like paying their bills, late payments, things like that? No, you typically want to give your money to people who have a history of paying their bills on time. They don't have any like red flags on their credit score, things like that, right? So first, we want to look at your credit score and credit history. I was explaining before. They want to see how you've handled debt in the past. Did you pay on time? Did you max out cards? Next is your income and job stability. But before we even get into the job stability and the income, guys, I also want you to understand that not having credit can be just as bad as having bad credit, especially when it comes to the mortgages. Because how they typically are looking at that situation, they're looking at it from a position of, well, we don't even know if this person can handle this payment because we don't see any history. Some lenders might let it go past with no issue, but just understand that sometimes that can be a huge impact. Now back to the income and job stability. Now they want to know, is your money consistent? Now, if you don't have consistent money, you do have some programs where you can't qualify certain incomes, but just understand if you don't have that consistent income, then you might be looking at more of a risk. Then your debt to income ratio. This is really big. It's called your DTI. That's just how much of your income already goes towards debt. Now, if you're talking about purchasing a house, it's not. You definitely want to keep your debt to income very low. That's really important. So if most of your paycheck is already promised to other bills, they're going to hesitate with actually lending you money. So keep that one in mind. Now, understand the debt that they're looking at is the debt that you have to pay or obligated to pay on a monthly basis that basically is not going away, right? So basically like card note, that's not going away no time soon. That will be calculated into your DTI. They also look at how much you're actually putting down, so your down payment. And then finally, they look at the property itself. A professional appraiser comes out to see if the house is really worth what you're trying to pay. They're not loaning $400,000 on a house that's $250,000. So just keep that in mind as well. Now let's talk about just some key mortgage terms, right? Now, let me run through some quick things basically that can always come up when you talking about mortgages and things like that, just so you won't be thrown off with words, right? So told you we discussed before. So with a down payment, this is the cash that you put up front towards the home. The more money that you put down, the less you have to borrow, which means the less you have to borrow means a lower payment. Always remember that. Now, the interest rate, the percentage that the lender is charging you on the balance that you owe. So that number matters a lot over the 30-year term. And I'm gonna just give you some quick math really quick. Take your interest rate, add it, double it, and then add a zero. And that's typically how much you're gonna pay over the entirety of the loan, right? There's just some like little rough, dirty math. So then we got the APR. This is like interest rate plus some of the fees. It gives you a more complete picture of the actual cost of borrowing. Now, one thing you can see when you look at your loan estimate, if you actually go through it, you can see that the actual interest rate and then the APR is actually different. Keep that in mind. So then now we're going to have a conversation about the closing costs. These are the fees that are due when you finalize the loan. So these include lender fees, title and appraisal, and all of that. So people forget about that part and get surprised. Don't get surprised, because you got to understand these fees will need to be paid at closing. Now, can you get relieved of these fees where you don't have to pay anything out of pocket? Yes, they can roll these fees into the actual rate and basically put it on the back of the loan to where you don't have to come with anything at closing. Just understand, just because you don't have to come with anything at closing, your rate can be higher and your monthly payment can be higher because of it, because they're rolling it into the loan. They're letting you pay it off over the longevity of your entire mortgage. So then let's talk about PMI, which is private mortgage insurance. So if your down payment is usually under 20%, that's when the lender will require PMI. It's an extra monthly cost that protects the lender if you stop paying. Typically, so here's the big difference between FHA, which is the government-backed loans, and then conventional. So typically with conventional, when you put down 20%, you don't have PMI. But no matter what, when you in an FHA type program, you're going to have PMI the entire duration of the loan, right? So whether you put in 50% down, if you go FHA for the lower rates and things like that, you're going to have PMI. If you are in a conventional and let's say you at 81%, you're going to pay PMI. But when you get to 80% and below, you can actually call up to the not title company, but call up to the lender and ask for them to remove it, because it no longer is needed for conventional only. FHA, you're going to pay it the entire way. So just remember that. So now let's talk about the equity. This is the part of the house that you truly own, like we spoke about before. So if your house is actually worth $300,000 and you owe $250,000, you got $50,000 in equity. Now let's talk about some pros and the cons of a mortgage. So let's say your home is priced at like $300,000. You put down 10%, so that's $30,000. So you're borrowing $270,000. That's your loan amount and your principal, right? So you get a 30-year fixed mortgage. So the rate stays the same throughout the entirety of the loan, right? So your monthly payment would include what? It would include principal, interest, and likely taxes and insurance. Typically, right? It's called PITIA. It's PITI, pity. So I'm not giving you exact numbers here, but because your actual payment depends on your interest rate and property taxes and your insurance, this is just here just to show you how all the pieces fit together. So as you can see, looking at here, in pros, it helps you buy a home without paying a full price. You can build equity over time as you pay it down. All benefits. Here are some cons: the long-term debt that can last decades, especially depending on your situation if you're not being smart with it. You pay a lot of interest over time over the life of the loan, and the risk of foreclosure if you can't make the payments. Here's one of those things where you have to be really strategic when it comes to purchasing a house, because people like to say a house is an asset. A house is not an asset. A house is a liability. Why is it a liability? Well, because liabilities, you have to pay for them. Assets pay you money, right? If you live in your home, how is your home an asset when you have to continuously pay for it every single month? And you're losing money when you pay for it. And then if any expenses or anything occur within the property, you have to pay for them. So don't look at a house as an asset, because it's a liability. I just want to make you guys aware of that and just keep that in top of mind. Now, let's just look at the simple mortgage example, right? So just looking at it, $300,000, down payment $30,000, same exact scenario. But here it's just more of a breakdown where you got the interest rate included, the long term, things like that. So a mortgage lets you buy a home without paying the full price up front. Most people aren't dragging you're kind of grand in cash. So as long as you pay the loan, and if the value of the home goes up, you build equity. So that's the wealth component, right? Now, once again, the cons is just long-term debt. You might be paying over 30 years. Over that time, you can end up paying hundreds of thousands of dollars in interest. And if your money gets tight and you stop paying, you risk losing a house through foreclosure, right? And if you lose it through foreclosure, 9 times out of 10, they about to auction it off, and somebody gonna get your house for way less than what you purchased it for. That's where the investors really come in. And a lot of people don't like investors, but it's just money has to constantly keep circulating, right? So you always want to make, when you look for a mortgage, think of it as a business decision, not just, oh, I like the kitchen. Just be really strategic, be smart in what you're doing, and you'll be all right. Now, final tip before you actually sign: always think of these few things. What's the monthly payment? Now, in the investment realm, we look at what's the total overall cost. But if you're somebody that's not, you just want a home, I want to build within my home, things like that, then this is what you just simply look at. What's that monthly payment? Also ask, what's the total cost of the loan over the full term? Now, typically people won't ask this question because they don't like to hear the answer. Because if you got a $300,000 mortgage and you're going to pay it over the full 30 years, if you actually look at the amortization schedule and you look at the full breakdown for as like interest versus the monthly payments and everything like that, and how much is actually paid for, you're looking at a property that you're probably going to spend close to $600,000 over that 30-year period. So if that's something where you like, I don't really care, I just want my home, cool. If that's a problem with you, then just be strategic. Sometimes that cheap sounding payment is very expensive over the long term. Second thing you should do, shop around. Look at different lenders. Different lenders can give you different rates and different fees. A small difference in the interest rate can mean a big difference over the 30 years. Read everything before you sign. If you don't understand something, ask. If they can't explain it clearly, that's a red flag. Typically, people think that realtors know everything in regards to this process. They don't. They know the buying and selling process of the property, but they don't know like intrinsic details of like loan itself, what everything means. So typically you want to speak with your mortgage broker. If you're dealing with a bank specifically, a lot of times with the retail banks, they don't know every single thing. So just ask questions. Make sure you hop on Google, search things. ChatGPT will really break a lot of things down for you. So there's no excuse on signing documentation and you don't know what's going on. There's no excuse for that. Fourth thing I want you to do is treat buying a home like a business move. Anytime you want to be inside of a transaction with a business move, you read everything because it's super important. You can love the house. That's cool. But the numbers still have to make sense. That's the biggest thing. Because just because you love it today does not mean you're going to love it 2 years from now if your pockets is hurting and the house is falling apart. And the last thing, this video is educational only. I'm not a personal financial advisor. I'm just giving you the game so you make better decisions and not go into this blind. Another thing as well, yes, I am in the finance industry. I am in the mortgage industry. So yes, I do have intrinsic knowledge when it comes to this. So once again, just real recap, don't only focus on the monthly payment, look at the total cost, compare different offers from multiple lenders, read and understand every document before you sign them, treat the home like a business, and then this information is just strictly educational purposes only. Now, if you found value in all of that information and you think that this is something that you could benefit someone else, make sure you subscribe and hit that notification bell. Don't forget to scroll down to the details. Check that out as well. Got some good info in there. And then I'll catch y'all on the next one. Peace.